1.1 For individuals and their families. Although various types of accident and sickness insurance can play a critical role in protecting the financial viability and longevity of many businesses, the primary role of most A&S policies is to protect the finances of individuals and their families during times of medical or health crisis. Financial goals of individuals and their families. Most families have a fairly common set of goals that require regular cash flow and a surplus that can be invested for the long term. Although the specific amounts and details will vary from family to family, the general objectives remain similar. Wealth accumulation. Once immediate needs, food, accommodation, clothing, means of travel, entertainment, and so on, have been provided for from current income, any surplus should first be allocated to setting up an emergency fund, 3 to 6 months of current expenses. Excess income can then be earmarked for wealth accumulation goals, both short and long-term. Wealth or assets can be employed to achieve a wide variety of family goals. To be invested in a home or vacation property. Building a portfolio of securities, registered and non-registered, to provide additional current income, growth or funds to draw on in retirement, or building a legacy to pass along to the next generation or to posterity in general. Retirement income. At some point, nearly everybody retires, but retirement means different things to different people. Some want to travel. Some want to sit by the lake at the cottage and enjoy nature. Others want to spend their time engaging in community help projects. The list is as diverse as our people. But all types of retirement have one thing in common. They all require income in one degree or another. Retirement income can come from a variety of sources. Government pension plans. Canada or Quebec pension plans, CPP and QPP, and Old Age Security or OAS. Employment pension plans. Private pension plans. Registered Retirement Saving Plans or RRSPs. Non-registered investments. Inheritances. Part-time employment or self-employment. And liquidation of assets. But almost all of these sources require that the retiree has worked, saved and invested for a significant number of years prior to retirement, and continuity of work can be interrupted by a number of factors, including economic downturns and disability. It is in the area of disability and the recommendation of products that can replace income during periods of disability that the life insurance agent has a significant role to play in protecting the financial welfare of individuals and their families. Family needs. Prior to retirement and prior to or concurrent with investing for wealth accumulation, families need to generate income and set aside savings to meet ongoing family needs. Tuition and room and board for higher education for children, orthodontics, family vacations. These and more all need to be provided for long before retirement, and many families are faced with providing extra support for special needs children, dependent aging parents, or so-called boomerang children forced by economics or other circumstances to return to the nest. Financial risks that threaten individuals and their families. Meeting family goals is primarily dependent upon a client's ability to generate sufficient income and savings over time. Unfortunately, there are a number of risks that could disrupt those plans, such as unexpected expenses, loss of income or savings, lower standard of living, inflation, longevity, and debt. Unexpected expenses. In theory, a budget will help clients to match income and expenses and prepare for future financial eventualities, but not everyone has a budget, Not everyone who has a budget is good at making a realistic budget, and certainly many people with budgets are not good at sticking to them. But even the best budget cannot anticipate every possible expense. Some expenses, like the need to replace a vehicle every 6 years or so, can be anticipated and planned for by setting up a sinking or savings fund to prepare for the expense. But others may come out of the blue and have the potential to completely derail the family budget. Loss of income. During a person's working years, especially the early years, financial success and security are all about income. Unless someone wins the lottery or inherits young, the only way that they can accumulate savings or a long-term asset base is by generating more income annually than they currently need to live on. But income is dependent upon both availability and the individual's ability to continue working. And even those with jobs could certainly find themselves without income if injury or illness caused a disability that kept them off the job for a prolonged period of time. Loss of savings. Either unplanned large expenses or a decline or loss of income or both could compel a family to draw down their savings to meet current demands. And depending on the amount of savings involved and the family income resources available, it could take years to build them up again. Lower standard of living. A lower standard of living is not really a risk in and of itself, but it may be a consequence of other losses: loss of income, loss of savings, loss of assets, and so on, which in turn may all stem back to income lost or unexpected medical expenses incurred due to injury or illness. This domino effect could often be avoided if the client has an effective A&S insurance program in effect. Otherwise, changing financial circumstances could compel the family to sell one of their cars, move to a smaller home or a rental unit, or to cut back on or eliminate family vacations. And a reduced standard of living isn't merely a physical change for the family. It could also create psychological changes that are a roadblock to ambition and productivity in the future. A reduced standard of living today could translate into substantially reduced income, assets, and lifestyle in the future. Inflation. Using the Consumer Price Index or CPI as a guide, for example, a basket of goods that cost $100 in 1998 costs $145.88 just 20 years later in 2018. That's an increase of 46%. And that during a period of historically low inflation. Looking at the long term, $100 worth of goods bought in 1918 would cost $1,545 1 century later. Although inflation in Canada has been historically low over the past years, 1.6% in 2017, it was not so long ago that it was at a much higher level, 12.12% in 1982. For those earning a living in times of high inflation, salaries have to increase substantially year over year just to allow the worker to maintain his standard of living. Likewise, disability income replacement products like A&S disability insurance need to be indexed to inflation in order for benefits to retain their buying power, particularly during periods of prolonged disability and/or high inflation. Longevity. Life expectancy in Canada has greatly improved since the early 20th century. The life expectancy at birth for men has increased by 20.5 years, from 58.8 years in 1920 to 1922 to 79.3 years in 2009 to 2011. During the same period, the life expectancy of women increased by 23 years, from 60.6 years to 83.6 years. In 1920 to 1922, Canadian men who had lived to age 65 could expect to live for 13 more years, and women could expect to live for 13.5 more years, to age 78 and 78.5 respectively. In 2009 to 2011, 65-year-old men were expected to live until they were 83.8, while 65-year-old women were expected to live until the age of 86.7. This means that from 1920 to 1922 to 2009 to 2011, the life expectancies of 65-year-olds increased by 5.8 years for men and 8.2 years for women. In general, people are living longer and spending more years in retirement. As a consequence, clients are going to need to accumulate more retirement assets than in the past if they want to avoid outliving their money. Increased longevity has the same implications for care costs for the elderly. Those who live longer are more likely to incur health complications requiring in-home or institutional care, and are likely to require that care for a longer period of time than in the past. Both sound reasons to ensure that a strong long-term care insurance program is in place. Not only has the average lifespan of retirees increased by over 50% over the past century or so, but so has the cost of living longer. In 1900, most people who lived well into their 70s, but who had health problems, were cared for at home by their families. Today, it is more common for the elderly who are in need of care to live in chronic care facilities, retirement homes, or nursing care facilities. With nursing home costs running as high as $5,000 a month, with monthly fees for private retirement homes often running much higher than that, many seniors may well be faced with outliving their money and being dependent on the government or their children. In any event, many will find themselves in the position of being able to leave a much smaller estate or no estate for the benefit of their children. Debt. Debt can insidiously erode financial plans and goals. Debt, of course, reduces net worth, the value of a person's assets, less his liabilities. Average household debt in Canada in 2017 rose to $1.7 of debt for every $1 of family disposable income. Overall, in 2017, Canadians owed $1.4 trillion in mortgage debt and $630 billion in credit debt. But it's not just the amount of debt that is a concern, but the carrying costs on that debt, most particularly credit debt. For example, consumer credit cards often carry annual interest rates on unpaid balances in the 18% to 24% range, or higher. At that rate, the $630 billion of credit card debt could have servicing costs in the range of $110 to $150 billion annually. In fact, many Canadians who are entering retirement carry substantial debt load, an impediment to the long-term financial viability of their retirement plans. Debt servicing, both interest and minimum payments, usually comes out of current income, and current income may be put at risk in the event of health problems like disability or critical illness. A client's failure to service debt could, in the extreme, result in lawsuits, foreclosure, and bankruptcy, unless insurance is put into place to replace the client's own capacity to generate income or to cover current medical costs. Personal risks that threaten individuals and their families. Aside from all the financial risks, people also face personal health risks that could derail their financial plans and imperil their financial security, such as the likelihood of disability, loss of independence, and the costs of long-term care. Likelihood of disability. An estimated 1 in 5 or 6.2 million Canadians aged 15 years and over had one or more disabilities that limited them in their daily activities, according to findings from the 2017 Canadian Survey on Disability, the CSD. Persons were identified as having a disability if they had difficulty performing tasks as a result of a long-term condition or a health-related problem and were limited in their daily activities. The prevalence of disabilities among Canadians tends to increase with age. However, more than 540,000 youths aged 15 to 24 years, or 13%, had one or more disabilities. This compared with 20%, or 3.7 million working-age adults 25 to 64 years, and 38%, or 2 million seniors aged 65 and over. Women, 24%, were more likely to have a disability than men, 20%, and this was the case across all age groups. In 2017, 57% of Canadians with disabilities had a milder disability, classified as having a mild or moderate disability, and 43% had a more severe disability, classified as having a severe or very severe disability. In all cases, the disability was severe enough to limit them to some extent in their daily activities. Loss of independence and costs of long-term care. Lastly, with people living longer and in receipt of better health care than in the past, there are more people living for more years with medical conditions, both physical, such as stroke, Parkinson's disease, for example, and cognitive, like Alzheimer's, that leave them unable to care for themselves independently. Many of these people rely on long-term care facilities for basic daily living, but often at a cost of $3,000 to $5,000 a month for full-time care. Needs met by accident and sickness insurance for individuals. In the event of illness, injury, or medical necessity, accident and sickness insurance can provide needed funds to buy time for employees, the self-employed, business owners and their families. Time to recover and return to productivity. Time to adapt to a changed health status, and time to weather the storms of an unexpected financial burden. As such, the needs met by A&S insurance for individuals include protection for income, savings, and assets. Protection for income. Although perhaps not immediately apparent from the title Accident and Sickness Insurance, one of the most common forms of coverage is disability income protection, insurance that will replace a percentage of a person's regular income from employment or self-employment if the insured is ill or injured and unable to work. After a suitable waiting period following the onset of disability, during which no benefits are payable, the insured will receive a monthly income payment from the insurer. The benefits will be payable for a prescribed benefit period or until the disabled insured is able to return to work, whichever comes first. Protection for savings. During a person's working lifetime, one of the many family goals is the accumulation of capital, savings in bank accounts, term deposits, and other short-term financial vehicles, as an emergency fund, or for near-term financial goals like an education fund, a boat or a new car, and so on. And investments, stocks, bonds, mutual funds, RRSPs, for longer-term goals like retirement. Unforeseen circumstances, such as sickness, disability, medical expenses, and so on, can lead to the erosion of both short-term and long-term savings. Fortunately, extended health insurance, which is a form of accident and sickness insurance, can defray the financial impact of many of these risks by providing needed cash to replace lost income or to pay medical bills. Protection for assets. Most people save for their retirement, although amounts saved vary. For example, according to a survey published by the CBC on September 13, 2017, 65.2% of Canadians put aside money for retirement in 2015 by making a contribution to either a registered pension plan, an RRSP, or a TFSA. And those assets, among others, do not necessarily get consumed during the retirement years. They're often passed on to the next generation through the retirees' estates, or at least that is the intent. Unfortunately, health issues in the senior years can bring expenses that deplete retirement and estate assets. Most retirees' group health benefits terminate at retirement, leaving them without coverage for dental and vision care expenses. For those who can no longer live independently due to physical or cognitive impairments, the cost of provincially subsidized nursing home care can run as high as $3,200 a month. That's in British Columbia, for example, with private retirement home facilities potentially costing much more. Critical illness and long-term care insurance can provide benefits to offset much of these costs, permitting the senior to maintain the value of his estate to pass to his heirs.